Hi everyone, Donnie Schultz, Embrace Home Loans here with your Market on Mondays update. It is Monday, June 13th, 4:30 p.m. We are finishing up a historic day on mortgage-backed security markets, Treasury markets. We are seeing full market capitulation right now where there is just steady selling that is driving mortgage rates higher. So again, finishing up one of the top five worst days on mortgage-backed securities in the last 10 years. At one point today, it was the worst day, worst movement in close to 20 years. We have pulled back a little bit. Things seem to hopefully be stabilizing here. But ultimately, this is not good for buyers. I have our 10-year Treasury chart up just to give you an idea of what's happening. This is all related to inflation. It's related to the Federal Reserve shifting policy to fight inflation, and markets are very data dependent. What we saw last week is a lead up into the CPI report, which is the main inflation report that's released. We saw markets moving up, hedging against a hotter than expected inflation report, and it's exactly what we got. Inflation came in hotter than expected, higher than estimates, and markets have sold off since Friday morning, and they really haven't shown signs of stopping. So the big question is going to be, where does the top come in? Unfortunately, this is coinciding with a ceiling that we were hoping had already formed back in the beginning of May. And you can see that, again, with this 10-year Treasury chart that I have up here. This is going back 6 months right now. Back in December of 2021, 30-year fixed-rate mortgages were around 3%. Inflation was moving higher. The Federal Reserve shifted their tone from saying it was transitory inflation to prevailing inflation, and they outlined policy changes to fight that, and that sent mortgage rates higher. And we could see that this pretty much went up in a straight line with a small drop down when Russia invaded Ukraine. We took advantage of some locks in this period, and we've been locking ever since. In the beginning of May, 10-year Treasury made it all the way up to 3.2%, and then it started dropping back down. That coincided with the last inflation report, which came in lighter than expected. And a lot of investors, a lot of analysts were hoping that inflation was topping out and that we were going to start seeing it move lower. And we saw the 10-year go all the way from 3.2% down to 2.7%. just 2 weeks ago. Friday, May 27th is when the 10-year bottomed out at 2.7%. Luckily, that coincided with some key moving averages. So on the lending side, we were aware of this, and we said that from a technical standpoint, this is a good time for buyers to be locking in, and we took advantage of a lot of locks. And then we saw this upward trend going into the inflation data. The two big red lines here, these are just Friday and today. Big movements since Friday. 10-year went from that 2.7 on the 27th all the way up to, we topped out at 3.44 today. It's an extraordinary move. It's a big move. It has a big impact on interest rates. On the 27th, we were locking 30-year fixed rate mortgages at 4.875%. If these numbers hold, tomorrow most lenders will have sixes in front of their rates. You're going to be seeing 5.875, 6%, 6.125, 6.25. Those are going to be the average rates on a 30-year fixed rate mortgage. Again, big move in a short period of time. This is impacting buyers who are looking for houses. This is going to impact buyers who are going into contract on homes, and this is going to impact buyers whose lenders did not take advantage of locks if a buyer's already in contract. Big question now is what happens from here. Again, widespread selling right now. Usually when you get into market capitulation, that does point to or at least point to the idea that we're close to a ceiling here. We hit 3.44, the 10 years down to 3.36. That in itself is a big movement on a day-to-day basis. Again, compared to today, it seems small, but that's big movement there. Could 3.44 be the new ceiling? It absolutely could. I think markets are going to wait and see what happens on Wednesday. Wednesday, you have the Federal Reserve announcement. They're going to increase their short-term interest rate. We've talked about this before. That does not have a direct impact on long-term rates like mortgages. In fact, as the Federal Reserve increases the short-term rate, that typically is going to have a positive effect on longer-term interest rates because of the projections of what the Federal Reserve funds rate going up does to the economy. It's going to slow things down. It's going to make things more expensive. Credit card payments are going to go up. Home equity lines are going to go up. Car loans are going to go up, and that is actually going to have a positive impact on longer term interest rates like the 30-year fixed rate mortgage. So, if we see the Federal Reserve come out and be a little bit more aggressive than what markets are anticipating, we do have the potential to see mortgage rates pull lower. It's just real tough to say. Buyers need to be defensive. They need to be on guard. The hope for the housing market is that we do top out here and we move back lower. Buyers were absorbing 5% rates, 5.25, even 5.5 pretty well. If we see rates staying at 6 or moving higher, 6.5, there's whispers of 7% 30-year fixed rate mortgages. That's going to pull a lot of buyers out of the market. That's going to have a direct impact on housing. Most analysts are calling for some support on the mortgage rate side. We have inflation, but it's mostly driven by oil and commodity prices. Now we're seeing inflation being dragged into housing, which has been a very strong sector of the economy. So there's a lot of analysts who are saying, hey, we can't let housing be significantly impacted by rising interest rates. And we're getting to a point where I think there's growing concerns of how the average home buyer can absorb these higher costs, right? Because values are still high. Now rates are high, and buyers are also paying more at the pump. They're paying more at the supermarket. These are big concerns here. Off the rate topic, a couple of announcements from Fannie Mae and Freddie Mac. You have a change to their guidelines for single-family homes with accessory apartments. If you have a legal accessory apartment, that's the key word, legal. It has to meet zoning requirements for the town that the property is located in and be permitted properly. Buyers are allowed to use projected rental income from that accessory apartment for qualifying. That's a big change. Before that, if you had a buyer who was buying a single-family home with a legal accessory apartment and they needed that income for qualifying, they had to go FHA or they had to qualify for a Home Ready, Home Possible program, which has income limits. Most buyers don't qualify here on Long Island. So that's a big change. Industry announcement on the co-op side, Wells Fargo has pulled out of co-op financing. So most of the co-ops that you are selling or working the buyer sides on, those loans are securitized by some of the bigger banks. Chase, Wells Fargo, those are the big players. Wells Fargo has cut out co-ops. They're no longer accepting co-op loans after closing. So that's going to impact your brokers. It's going to impact your correspondents. Embrace Home Loans is actually in the final stages of finalizing our Fannie Mae approval for co-op lending, so everything's handled in-house with us. Once that is signed off on, that's going to give us opportunity to gain some market share in that space. Any questions on that front, you can reach out to me and my team anytime. Again, hopefully next week we are connecting and rates are pulling back lower and we're taking a deep breath here, but definitely something to keep an eye on for our buyers here. Talk to you guys soon. Have a great day. Appreciate everybody.